Hi Angela, this was the expected outcome, rates being left on hold. What factors do you think were most influential in the board's decision today?
Yeah, look, thanks, Nadia. And it was very much within expectations. I think it would have been a real shock before Christmas, a welcome one for households out there, obviously, especially those of us paying mortgages, but a real shock if they had have cut today. Look, I think going to David's point, the issues the Reserve Bank's really facing at the moment is how confident can it be that inflation is going to indeed return to target in the medium term. It wants to make sure that it has done enough to slow the economy down, to bring inflation back within target. When it is confident enough, it will start to ease monetary policy and those rates will come down. Now, I've only managed to just glance at the statement from the Reserve Bank in about the 30 seconds I had from when it was released to when I came on air, but it looks like that confidence is gaining. So there is some important changes in what the Reserve Bank's saying after this meeting, which should give some people confidence that they are getting ready to move on cutting rates. That will make households feel a little bit better going into Christmas, that there is some hope of that relief, hopefully early in the new year. But we will have to wait and see. Before they next meet in February, we'll get another read on inflation, which will be critical in terms of whether or not that confirms that downward trend. And of course, we'll continue to see what's happening in the labour market. Now, the labour market's remained very, very strong, and that's one of the reasons the Reserve Bank is hesitant to move. If we see some increasing weakness in the labour market, then I think that February rate cut becomes even more likely.
Done very well to speed read that statement in the past 30 seconds. We will hear more on that statement from my colleague shortly. But the question everyone wants to know, I suppose, when do you expect to see interest rates will start to come down?
Look, I think it will certainly be in the next half of next year. The question is whether or not the Reserve Bank moves too soon or too late. So they are really, and we've talked about this, it's a tightrope. They're trying to bring inflation down without causing a recession. Now, we've seen with the latest figures in terms of how the economy is growing that the only thing keeping the economy in the positive at the moment is the government, is fiscal policy. That means the private sector is very, very weak and is really calling out and urgently calling out for that rate cut. The Reserve Bank will move when it feels confident that it can do so without unleashing those inflationary pressures. Now, the hope is that that will be in February. I think there is all indications that really we're getting enough indications now that the economy has slowed enough for the Reserve Bank to start easing monetary policy. But we are going to have to wait and see. It is going to really depend on what the data says between now and then about whether or not the Reserve Bank feels confident enough to move. They've been relatively conservative, it would be fair to say, as a central bank goes, and central banks tend to be relatively conservative. And I guess the risk and the concern that some economists have is that they wait too long, and as a result, unemployment goes higher than it needs to and the economy slows more than it needs to.
That is a key concern. What sort of economic data will the RBA be wanting to see in the next few months before it begins to cut rates? Just talk us through the significance of some of it. We hear a lot about GDP, unemployment data, wages. You were talking before about labour market data. What are the really key figures that would sway the RBA's decision next year?
So I think if they can see unemployment starting to go up, which is a pretty negative and I guess Grinch-like metric to be aiming for, so wanting to see more people out of work, unemployment stayed at around 4% for most of this year, and the Reserve Bank had been forecasting that to head up towards 4.5%. It hasn't happened. If they start seeing more weakness in those labour market figures, that will be an indication to them that maybe they have indeed gone far enough. And then they'll get another read on quarterly inflation. We get these monthly inflation figures, but they're not the whole picture. It still really comes down to those quarterly figures, and they'll get another read of that at the end of January. If that comes in again with that trim mean and particularly that services inflation starting to come off, that will give them a bit more confidence that indeed inflation is coming back towards target and that perhaps they can think about cutting. They've certainly seen enough weakness, I would say, in terms of the GDP figures. We saw with the figures coming out last week exactly how weak the Australian economy is. It's literally crawling along the ground at the moment. So they've definitely seen that figure, but when that translates through to unemployment and to those inflation figures, that's when I think they'll have more confidence to move. But look, if it doesn't happen in February, it'll definitely happen by May, and we'll start to see that easing. But then there are still these remaining issues within the Australian economy that need resolving. The housing market remains incredibly tight, and that's causing higher rents than perhaps necessary. So there are more structural factors at play as well, of course, that the Reserve Bank doesn't actually have much control over, well, none actually, through interest rates. So there's a broader conversation to be had as well about how do we generate this sort of a next wave of economic growth in Australia.
That's a bigger conversation, but a crucial few months ahead before the RBA next meets. Angela Jackson, thank you very much for your time.
Thank you.